Good morning, ladies and gentlemen. Well, for weeks now, I've been telling you to be very wary of a model which goes into risk off without the score being negative. And having drilled down for several days now into why it's going negative, it's because of the behavior of XLY and XLU. XLY is readily explainable because it's very heavy in Tesla, and Tesla has its own problems, and that's XLY covered. XLU is really diverging from its normal behavior, and that is likely to be because of the electricity demand that the market guesses is going to be necessary for AI to run properly, and therefore the electricity companies within the XLU sector are rallying right like crazy. So I don't think this is a normal risk off. The score is still positive. There are plenty of sectors and plenty of spreads which are positive. This is one of those periods when one should ignore the model and really concentrate on what the data, the economic data says, and we are going to have plenty of it this week, both for the real economy and for inflation. And I think the combination of the two is going to set in stone almost what is likely to happen for the next several months and what the Fed can and cannot do. It's pretty redundant to look at what happened last week in the bond market because the answer is that nothing happened. We had zero data. The auctions went okay. Nothing to write home about, but every single auction yet again is underwater. So nothing has changed there. Next week things will change. Why? Well, it's a pretty weird how the data comes out because we have PPI before CPI, which is very unusual. But we are expecting both zero point 0.3 for CPI and PPI. So I guess it makes no difference which one comes out first. Let's see what is likely to happen, especially to the short end, if the data is hot or the data is cold. If the data is hot, it's pretty simple to work out the levels that you want to trade at the short end at twos. Hot data basically says that there is no possibility of the Fed gaining greater confidence, which is what they're looking for. And really twos are likely to trade at 5 or even 505. You want these guys are all going to get stopped out, and we could even get 507, 509. This is where I want to get in heavy on twos on the long side, simply because I think the bar to raising rates by the Fed is so high, you would need to get now an acceleration of the numbers for anybody to start thinking, or even for the Fed to start thinking, that they need to hike rates. Therefore, once twos are at those levels on hot data, all you can really do is buy them, and from that level, wherever the yield curve is, I think the yield curve will steepen again, because twos are really not going to go any higher than this 509 level, and then the whole yield curve will catch up to them via the steepening. That is the level that I want to trade on hot data. On cold data for CPI and or PPI, the twos should probably react the most as well. I would have thought that people will start building in at least a 50% chance of an easing in June. We know that they are chomping at the bit to ease and they're looking for excuses. I think even 1 month of cooler CPI is going to be enough for for the market to price in some percentage chance. And I would have thought 50% is probably the right chance of them starting the easing cycle in June already. And I think that twos then will start the cascade that they normally have all the way back down to the lows of the year. It's going to take time, but I think that that will be the direction, especially if retail sales confirm any kind of slowdown in the economy. Retail sales come out at the same time as CPI. Imagine a combination of weak retail sales and then a cool CPI as well. I think the yield curve is going to steepen out of sight as a result of that. Now, what will be even more interesting is a combination of a, say, in-line to slightly hot CPI and a very weak retail sales. That is the environment in which twos actually do best relative to the rest of the yield curve. Why? Because the Fed shouldn't ease, but the market will start building in a probability that they will look at the second part of the mandate more favorably than the first part of the mandate, which is the inflation part. And that is the environment in which really the bond vigilantes can come into their own. So if we look at twos, tens, if we get retail sales weak, i.e. a weakening economy, but CPI in line or even slightly warm, I would have thought that twos, tens has to steepen. And we really have to go and retest these levels around 16. And that is where I really want to start getting in heavy on the steepener. Until that environment comes out, as I told you last week, it's just going to go up and down, and really, drive you crazy. So what I'm saying is that what you want to do is wait until Wednesday and then decide what you want to do with the yield curve. And my favored path is the one of steepening. I don't know whether it's going to be a bull or a bear steepening. I just know that weak retail sales and then possibly followed by a number for unemployment claims, which is higher claims than expected, again for the second week, is really going to get the animal spirits going in the yield curve. You will see masses of people trying to front run the reinvestment risk and going into twos and threes and avoiding the long duration, the 10s and 30s. That is going to be the really interesting path forward. It's going to be one of very aggressive steepening if that is what the data says. So once more to summarize, if the data is hot, you are looking to buy the twos around 507, 510, and then put on the steepener, because once twos have reached this kind of level, I think they have nowhere to go. I think the odds of them ever reaching anywhere close to current Fed funds are very low indeed. There's no way that the market is going to immediately price out cuts forthcoming in either 2024 or 2025. And that is after you've bought the twos at these levels, that is when you want to put on the steepener, because twos are going to go nowhere and the curve can only then give up on the 10s and 30s. Slowly, the 10s and 30s are going to go back up towards 482 in the 10s and in the 30s they're going to go to these levels around 495. That is what has to happen. The huge supply is just not going to allow these contracts to stay where they are at the moment. It's the term premium is at zero. Bad news is bad news for the whole curve, but once the twos have arrived at the level that everybody wants them, because there is reinvestment risk over time, that is when the curve can do nothing but steepen. And really the steepening is going to be most in the two stands. I would have thought the odds are that we get to something like 45, 47, and then it just starts collapsing towards 16. I think that that is the highest likelihood on a hot number. On a cold number, especially if retail sales are weak and then unemployment claims are strong, i.e. more unemployed, this curve just implodes down. And it does, and it certainly has to break this 16 level and start going positive. It will be, to me, that is the highest likelihood over the course of the next couple of weeks, given this data. But we will decide once we've seen the data. I can't possibly guess what the data is going to be, but I know my favored side and my favored scenarios, and I've just described them with reasoning. Very little reason to look at what happened in Germany either, because nothing happened is the answer. But I think the scenario in Germany is going to be very similar to the scenario in the US next week. We all know what the Bank of England said last week, and that is that they think that they might at some stage start to ease, and that easing could be more than the current market pricing. And we also know that the Riksbank in Sweden cut rates for the first time since 2015, I believe. I can't remember now. So we definitely have this easing bias in the market from the central banks, and what they're looking for is the data to justify what they would like to do. So if we start getting that kind of data, I would have thought that Germany is going to match the US almost 1-for-1. Not quite, but almost 1-for-1. And really, I think that Schatz will start going down towards this 268. Now, what is the level of Schatz that I think is unlikely to be broken, almost whatever the data in the US is? And that is this 312 area up here. These guys will get stopped out, but around this 312 to 315 area is really an excellent area to go long of Schatz. And just like I want to go long of 2 years at the levels that I showed you around the 507 to 509, I want to go long of Schatz at 312 to 315, and then look for a curve steepener there as well. What will be also interesting to look at next week is this relationship between 2-year Schatz and the 2-year JGB. It's been going sideways for quite some time, and of course a sideways stable relationship at 260 basis points favors the euro over the yen, and that's why euro yen has not been able to top out. But now if we start getting the weak data out of the US and it's matched from the EU side, you will find that it breaks this 253. A signal to get short of euro yen is going to be this break of 253 to the downside, and I will show you that later. I just want you to have this chart in mind as we go into CPI and retail sales on Wednesday. Well, the dollar ranged exactly as expected last week within the Bollinger Bands. It really did nothing. And next week, we might get a breakout. Either we trade 106.30 again on hot numbers, which do not allow the Fed to ease anytime soon, and retail sales is strong, then we start going and testing these levels and trying to stop all the people who are short around this 106.25, 106.30. That is for sure. The more interesting path is going to be if the data is cool, because then we can really start testing these levels around 104 again. I don't think it breaks it in any great hurry, but it will put a lot of doubt in the mind of people who think we're going to get a stronger dollar. And therefore, that is going to be the more interesting trade, because after some consolidation, I think we would then test 102.82, and in the weeks ahead even go down towards 102.35 and towards the low of the year. And that will give me a lot more confidence that the short end of the bond market is the one that's going to rally most. But let's not get ahead of ourselves. I think that the Dixie is going to basically reflect what the differentials are. So there is going to be not much difference in the way the Dixie trades to the way that the short ends of the US and Germany trade. Euro yen is actually trading much the way that I expected it to trade, i.e. stop everyone out, spike, intervention, back down to a moving average, which makes sense. This is the 50-day moving average, and bounce off there. Why? Because the differentials, in the chart that I showed you, the 2-year differentials are still, going nowhere. And if the differentials are going nowhere, the natural path for the euro yen is to go higher, because you're getting a 265 pickup on being long the euro as opposed to the yen in the 2-year. Now, if we start breaking 253, I think that is the moment that you want to actually short euro yen, because not only is it going to test this 164 area, but I think it's likely to go and test this 162 area, and in time probably do an ABC all the way down to this 160 area and the 200-day moving average. So you're going to have quite a bit of room to get short, and looking for some decent appreciation. It's going to take time to change this trend, but I certainly think that you have room if we start on Wednesday breaking 253, 252 to get short and look for around the 160 to trade. Gold is going to be one of the interesting ones to watch if the CPI is hot but retail sales are cold. I think gold would be the biggest beneficiary there, and I certainly think it would go up to this 24, 15, 20 area. If the economy is weakening and inflation is hot, that is the scenario that the Fed would dread the most, and in which, in this election year, it might start abandoning the first mandate in favor of the second. That is the scenario that people shut their eyes and buy gold in. And, we will see. We'll see what the data says, and I am fully prepared to have to buy gold. Because if they start switching their scenarios around and favoring the second mandate, I think gold can make new highs without any problems. First thing I'm going to look at on Wednesday is the retail sales data, even before I look at the CPI. And if that is the kind of data that we get, where they might start favoring the second mandate, wherever gold is, I'm buying it. DBC, really nothing to see here at the moment. It looks like gold should be favored to DBC because this consolidation has been, going on for a while. All the moving averages are pointing higher, and really you want to be looking at gold as a buy rather than DBC. Oil is stable just around the 77 to 80 area. It won't go up for a while. To me, gold is more interesting than DBC. How are equities going to react to the data? Well, I don't think that they're going to react very strongly to the inflation data. They're probably going to react far more strongly to the retail sales data. And I'm talking about their relative performance to other assets there. Equities, we all know, are a far better hedge than bonds to inflation. Therefore, they're not really going to mind sticky inflation. Say the number is 0.3, they're not really going to get hit. The only bit that's going to get hit at 0.3, as I said, is really the 2-year, which goes back to discounting nothing at all from the Fed, and then the rest of the yield curve can follow it. But that is not really going to hit equities very much. What it is going to do is, what is going to hit equities is a weak retail sales. And only if there's a weak retail sales, then you could see this ITOT against government, even go down a little bit. So I'm not really worried about equities unless I see a very weak retail sales and unless I see a weak unemployment claims. I think unemployment claims is being undervalued by the market at the moment because we've got our first weak number last week and weak in terms of, more unemployed. And if we now start getting a second number, you can no longer say, oh, it's all from New York State and it's an aberration. It could well be an aberration, and it's more likely than not to be an aberration. But if you start now getting a second number, that starts getting seriously worrying about, the second part of the Fed's mandate. And however much the Fed eases, equities aren't really going to like that. They'll go down less because of it, but they'll still not perform. The ideal for equities next week and this chart is actually going to be a relatively sticky inflation, but that's nothing to write home about, i.e. a 0.3 number, and a strong retail sales. In which case, who is going to buy bonds and why? And all the money is going to go out of bonds and into equities, and this chart continues its path upward. And since we know that bonds aren't really going to go a million miles, equities aren't going to go down either, and it continues to be a buy the dip environment. Well, equities last week told us that they are strong. What do I mean by strong? I mean that they had a natural opportunity to fail at this level, which was the gap fill level around the 5200 area in the SPX, and that's where we got short. And what do we get? We got this move down of about 40 points. Now, it had every chance to fail there and come back down towards the moving averages a bit more and fill this gap. But no, it decided to continue going higher. And therefore, that to me is a sign of strength. It's a sign that dips are going to keep on getting bought. So if I had to guess what the numbers are going to be next week, and what the market is saying the probabilities are that the numbers are next week, is that the retail sales is strong and unemployment claims are low, and that inflation is, as expected, maybe a tad stronger, but nothing to write home about, that the reaction in bonds won't be huge. But even if the numbers are not, as I just stated, that equities are going to hold in much better than bonds. And that is the likelihood. It just is what the market is saying, what the probabilities are saying, and what is most likely to happen. Of course, we know what our alternatives are and we are ready for them, but for next week, I would have thought the odds are that at some stage you have to buy equities. And the strongest equity market is actually Europe. And that's because of the European banks finally getting re-rated after a decade plus of trading basically under book value. So what can we tell about European equities? And this is, of course, the stocks. We can say that while they trade and close above 48.50, which is also the monthly level, until they close below 48.50, you are a buyer. You're a buyer of all the dips, and you prefer European equities to almost everything else. I think really it's that simple. There is very little reason to believe that European equities are not going to be the stellar performer for the next couple of months. Just a last look at SPX. Now, unfortunately, what I have to say is that unless it starts breaking down, which I think is not likely, we are likely to get at some stage a close above 52.55. If we get a close above 52.55 and I enlarge this, I think the likelihood is that we have another leg higher of at least a couple of percent, and that's 100 points, because this part of the chart, it will be nowhere near overbought as yet. It has to get up to these levels to get overbought, and it'll have plenty of time to do it. That says to me, close above 52.55 and equities are gone for another 2%. I hope I've been clear about what my intentions are. I either want to buy twos around that 507 area and then really put on a steepener, or I want to just buy the steepener, or I want to buy the, see what the numbers are and then decide whether I want to go into bonds or equities. And I think the likelihood is equities. That's all one can say before one's seen the numbers, and the mix between the retail sales and the CPI is what is going to decide us as what the next move is. Gold is going to be interesting to watch if the mix is as I described, but also really I think the allocators between equities and bonds are going to be out in force on Wednesday once they've seen the number, and you might be surprised by how much money they switch around or put to work. Thank you very much indeed, and tweet you tomorrow.